I'm Andrew with Legacy Acquisitions. I'm your host. Andy McMullen is my co-host. He's the managing partner at Legacy Acquisitions. We are right now focused on building 500 homes across 3 built-to-rent communities. We're focused in Lafayette, Louisiana, and Foley, Alabama right now. And we really love having these conversations. We believe the best way to learn about real estate investing isn't just the deck. It's from hearing from operators who've been through cycles. Well, I see something good happen, Chuck. And people who have built things, they've lost sleep over things, and they've just kept going. And we've got someone who's done that today in Chuck Weldon. He's a principal at Weldon Field. It's a family-owned real estate company out of Birmingham, Alabama. It's been operating since 1970. They focus on alternative investments in real estate opportunities, including acquisition, development, and construction for multifamily, single-family, hospitality, active adult, and land development. Are really focused on projects across the Southeast and beyond. And one of the things that I really, we're going to talk about some today that's unique about Chuck is just how he thinks about this business. There's a lot of correlation with how we think about it. Certainly, conservative underwriting. We're going to talk about that some. But really building it on long-term relationships. He's faith-driven and just focused on building thriving communities that the folks living in them love being there as well. And so, Chuck, welcome. We're glad to have you.
Glad to be here. Thank you for the opportunity.
Yeah. So I'll just get into this. First question. So your dad and uncle started Weldon Field back in 1970. Is that right?
1977. We were really good at marketing. Really good at marketing. It's Charles Weldon, Edgar Weldon, and Pete Field, Weldon Field. So that's as good as we could come up with marketing wise.
Okay. So tell us a little bit about that. Second generation. You've taken over the business, been leading it for a while. So talk to us a little bit about that transition.
Sure. Just to make sure I don't get in trouble with my other partners, my brother Bill runs the property management company along with my cousin Ed, who's Edgar's son, and then Robert Field, who's Pete Field's son, runs a lot of the development and a lot of the banking and other relationships with me. We work together more. So we'll make sure they get credit. I am the oldest, so therefore I think I'm in charge. I'm not sure they would always agree with that, but that's my personality anyway. It's interesting working in the family business. Somebody told me one time, blood is thicker than water, but it boils faster. And a perfect example was we used to have a board meeting every month with my father, my uncle, and Mr. Field, and then the 4 sons. And in one of those meetings, my father said something I didn't agree with. And I was smart. I had already disagreed with him a few times and not come out on the winning end. So I had learned a little discretion. So I looked at my father and said, before I respond to your answer, which hat are you wearing? My father, my biggest investor, the owner of the company, the line of credit on my house and everything. So which hat are you speaking from? He goes, all. That was the end of the conversation. I mean, we just moved on to the next question. So you have to, if you're in a family business, there are some interesting dynamics you have to work through. But they've been great to work with. They gave us enough of a rope to hang ourselves, but they really tried to keep us within some bumpers and boundaries. And I've really been blessed to have those 3 gentlemen as my mentors because they all came from a different background, totally different backgrounds.
Well, kind of along that line, taking it over this next generation, taking it over. What's it been like as far as keeping the culture intact, growing that, especially as a company scales? What's that been like for y'all?
Well, as you know, people is always the biggest factor. I mean, if you don't have the right people, you can have the best ideas, but at some point without the right people, it will not stay successful. So I think culturally, having the right people that are like-minded, aligned with you, have the same values you have. I would tell you over the last 10, 15 years, Weldon Field has become more overt in its faith. It always had elements of it, but I think in the whole movement, I mean, Andy, you and I talked about what you're all doing at Legacy. I mean, there's a tremendous amount of things that y'all are doing from a faith perspective that y'all, I mean, we met at Redemptive Real Estate, for instance. So I think that the overt nature that so many businessmen are now endorsing, accepting, immersing themselves in, we were all scared. Basically, it's like a baseball game. We were all at the plate, but the liberals were throwing these fastballs, moving us off the plate, and making us think that anything if we mentioned Christ, if we did anything, if we offered mission trips, if we did anything that had a spiritual nature, we were bad guys. And that's changed in the last 15 years. People like y'all, T Factor, Sovereigns, have all helped reshape that. So that is really come into our company a lot more in the last 10, 15 years because of that.
So let's just stay on this track a little bit, Chuck. So you talk about business as mission. Some people may have not heard of that term. One of the things you talked about a chaplain is deploying volunteers, folks to live on site in your communities and build relationships with residents. What's that look like? Kind of practically from a day-to-day standpoint.
Yes, great question. Yeah, I'll define business as mission for those who, in fact, I printed out because I use the same definition over and over again. It's the strategic use of authentic business activities to create opportunities to minister and evangelize within the business's sphere of influence. So every one of our businesses has a sphere of influence. Everyone has a certain amount of missional potential. There are people that you come in contact with that are far from God, that have not heard about him or don't know him. And what we do is we've taken a percentage of our real estate business on the apartments and said, we're going to go buy, we bought like 8 or 9 properties now in this fund. And in this fund, we have investors that are Christians that want to have an impact investing, a positive impact, a spiritual impact. So we have put people on site, 3 to 6 people per site. They get a discount on their rent. They give us 10 hours a week. And during that 10 hours, they're prayer walking, they're hosting social events, hosting Bible studies, meeting the needs of our residents. A mother gets sick and the father can't get home quick enough, they'll go over there and babysit. So it's all about meeting people's needs because nobody cares how much you know, so they know how much you care. I mean, that's really a very big tension in apartment communities. For all of y'all in apartments, you know that average person only knows 4 people or 3.5 people. We don't know who our neighbors are. And so if we can create a culture, think of it as Young Life. We're basically Young Life on apartments, or Apartment Life does something very similar as well. And we've had 70, 80 people come to Christ as a result of those conversations, and as a result of meeting needs and loving on people in hurting times. I think we have an unfair advantage in apartments because everybody's there for 12 hours a day. I mean, we have the biggest chunk of time of everybody in the world, more than any other business sector does.
Yeah, I imagine a lot of it comes from within these communities, right? I love that idea of adding actual people in the communities, using them. And so I imagine you're giving them some kind of resources or, the money for barbecues or events like that. Seems like it's so powerful. I imagine on the business end too, they stay longer. The residents stay longer. They're referring folks. They're happy. They want to be there. They want to help. We've run into some, I wouldn't say a lot, but some issues with investors say, hey, why do we need to do that? Why is this money going to these programs and not those programs? How do you answer them?
Well, first of all, you're right about that. We tell investors they'll make 1% to 2% less IRR because we dedicate costs to have a monthly big event, Super Bowl party, St. Patrick's Day, Thanksgiving, whatever the events are, plus Bible studies, community service, different things to engage people. We really believe in Apartment Life's research has shown that it really doesn't cost you anything because of the very reason you just said, Andy. People stay longer, they give you better reviews. People, they tell other people, they leave the property in better shape when they leave because they leave happy. And so there's less turnover expenses. So we think fundamentally it's a break even or money maker, but we tell everybody this can cost them. But our investors, Andy, are actually In our case, in the two funds, we've got about 50, 60, $70 million in the two funds. Those were all Christians that we knew that wanted to have an impact with their dollars. So there was no question for them. It's a little different than some investors, Andy. These were all committed believers.
Got it.
But I'll tell you, based on Apartment Life's research, whether you're Christian or not Christian, if you serve people and love on people, they stay longer and they're better residents. So it's a win for everybody.
That's great. Share us, Andrew, we talked about conservative underwriting. I know there's probably people in this audience that rolled their eyes when you said that, because everybody, I haven't heard a person yet that says, well, I'm a little aggressive on my assumptions there. I just wanted you to know about it.
It's like somebody saying, I want to be fair. What does that mean? I want to be fair. I want to see human flourishing. I want to be conservative. Yeah, it means nothing.
Yeah.
So let's hear how you typically kind of, enforce that in some of the deals that you guys underwrite.
Yeah, well, one thing is we want the people who, we're a pretty flat organization, so we don't have layers of people. So for instance, the guy that buys the property, does the rehab, does the asset management, and stays with it from cradle to grave. So if he makes a bad choice, it affects him for 5 years. So one thing is having alignment with your team. Their upside, their downside are impacted. So it really helps act as a restrictor on how risky they want to be. Number two, a lot of our investors are friends. I mean, really, I'd say 89% of our investors are friends. And I've disappointed my friends, by the way. We've lost money, but I don't like to do it. And we fight very hard not to do it. And then there's the typical stuff you would do as far as cap rate going in versus cap rate going out. What's your view of interest rates? We try to always assume that when we sell it, it will not be as good as it is today. And so that's a little bit of extra hedge on protection. But I'll be honest, I mean, even when we're doing single family, we've done thousands of single family units. If we underwrite at 4 units per month to sell, 4 homes, and you underwrite at 8, but it goes to 1, we're both going to lose money. You're just going to lose all your money, and you're going to lose it quicker. I may still lose my money and maybe slower, but there are times, 2 or 3 times in my life where the market has made such a deep correction, 08 being one of them. And today, right now, anything you bought in 21, 22, any vintage 21, 22 asset is either totally underwater, totally gone, being recapitalized, or you got lucky. Because 4% difference in interest rates is hard to make up on rental rates and operating expenses.
Yeah, Andrew, I know you wanted to talk more about kind of maybe some of his experience in the cycles, but just one follow-up question on that, because we've been part of LP deals, part of GP deals where the NOI was the same, right? Maybe they lost a couple folks, maybe they gained a couple folks, but if you've got interest rates that go that high, it's impossible to recover. And so maybe some guys are, okay now, but they're in a sinking ship. What would you say? How did you prepare your investors for that? Because I think there's a lot of people on this call probably experienced a version of that if they invested in 20, 21, 22. We were somewhat building through it as it was happening, but certainly as we're stabilizing, no one made assumptions that we were going to be coming out at 6.5% or 7% interest rates at that time. So how did you prepare your guys for it, your investors?
Well, we just think transparency. I mean, we do quarterly reports like most people. And so every quarter we send out reports on every asset, hotels, single family, multifamily, new construction, value add. And we give them a total update of where it is. And sometimes we'll bookend it. We'll say, we really can't predict anymore, but this is the 2 bookends. If rates do this, this is likely to happen. If rates do that, this is likely to happen. But we're very big on offering phone calls, meetings, and not hiding. I mean, of course, I know most operators don't hide, but some do. But I just think you got to be timely on your information and transparent and offer to get in meetings. I mean, don't be scared. Just talk to the investors because they need to know that you know what you're doing. But unfortunately, you're going to lose money sometimes. It's just going to happen every now and then. we've done hundreds of deals and lost money maybe 8 or 10 times, but it's happened. It's happened.
Andrew, can you see
Let's
me
get
now?
in. Yeah,
We
yeah,
see
we
it,
can.
Okay. All right. I'm sorry for that, but I just, I want people to know that I wasn't hiding in the dark. All right,
No.
go ahead.
Yeah, so let's talk about that some more. So, Chuck, Andy, you guys have been through multiple real estate cycles. Each one, there's probably some crossover from one to the next. There's also some unique things about each one. You mentioned 2008. That's certainly one of them. And then you mentioned, about what 4 or 5 years ago, and kind of what happened there with interest rates. So, as you just think about real estate cycles and how you work through it, right? Like building, having a value add. Sometimes it's a lot easier to get that return from for investors, and sometimes it's a lot harder. And so when we going back to underwriting, when we're talking about that, what are some things that you guys have seen, in the tougher parts of a cycle that can really go a long ways to sparing investor capital and maybe getting a minor win versus a major win.
Well, it really depends on the cycle because sometimes the limitation is debt. Sometimes the limitation is material. So let's take COVID, for instance. Materials and inflation were your enemy. I mean, you couldn't get transport, you couldn't get boxes, electrical panel boxes for a lot of properties that were trying to open. They were delayed 6, 9, 10 months because of that. In '08 is a case of debt. Debt was impossible to get. 21, 22 is you can get debt, but the rates and the loan to values are totally different. So what's interesting about this is it's a very, very fluid situation where you have to assess what are the limiting factors and what can I fix and what can I not fix. And because it's not like your operations are going to be similar. This is not like a situation where you're just betting on something. You kind of know what you're doing, but there's things beyond your control. So we found that in each of these situations, we just have to sit down and figure out what can we reshuffle. Because a lot of times it's not one thing, it's multiple things trying to improve them 5 or 10% here, improve the insurance. For instance, we go to London. We have a lot of our friends go to London to try to get cheaper insurance rates instead of just relying on brokers in Atlanta or Chicago to represent them. So we saw people try lots of different ideas. But I do think in the end, it's really basics. And it's good people on site. We've seen over and over again, if you don't have the right team on site, they'll kill you. So that's one of the big things for us as people.
Yeah, so I was just gonna hit on that, Andrew, because I go back even a little further. Chuck, with the .com crash, I was kind of maybe 2, 3 years into the business, and I was doing commercial real estate, and we were leasing to all the pets.com of the world, and we had these letters of credit, worth $1 million. So we're like, oh, we've got all this security and deposit, and lost 50% of the tenants, right? So I think Chuck hit it. It's what are those decisions that you can make, and what can your people execute that's in your control. And that's the part is a lot of people, and now we've been through multiple cycles. We lost tons of operators over just this last cycle because they didn't know that this was part of it, right? If I get wiped out, then I can't move on. So I think when you've got things like in '06, things were starting to come around, and then we kind of started to see some signs. A lot of luck involved, a lot of God's grace that we kind of got out of that cycle. But it was ultimately about when this fit hits the shan, do you have people that are really going to step up and try to find a way to fix it? And that's what happened in 2008. If you remember, the market Chuck didn't really even come back till 2012. So we were figuring out ways to make money, take care of our team, invest in, small apartments here or there, whatever kind of additional cash flows you could find, or invest in other businesses or other kind of ancillary income opportunities. But there's people that I know that turned off investing in 2018, and they lost when they came back in 24, right? But they had that they were so sure that we were in that down cycle that they left a lot of money on the table. So I think it depends on your risk, but when you're dealing with investors' money, man, it is just so important that those little dials that you can turn, which is the property management piece, and can you get you just a little bit better debt, and can you raise just a little bit more cushion, right? Can you have a person that's really holding all of your managers and construction docs and all that accountable? Those are kind of the small wins that you can achieve, but some things just aren't achievable. Every business, right? It's not people talk about they're on this call and they're like, well, yeah, this is the real estate business, right? It's really risky. Well, no. Every business got wiped out in those cycles, right? In some form or fashion. So,
Andy, I like
all
your
right.
answer better. I like your answer better, but let me add one more piece to that. I think if you see a company whose team stays intact during that time period, then you know you have a great team because you're really looking for people who are not mercenary, who are not going to jump just because this ship has got taken on some water. They want to help it right size itself again. And I bet you, if you go look at the really good operators, most of their team stayed with them the whole time. You don't lose institutional knowledge. You don't lose the relationships. And I always thought it'd be interesting to write a book or a study on did the companies where more people stayed do better long term as far as returning equity? My instinct would be yes. I never proved it. But Andy, what's your comment on that? Do you think that's important as well?
No doubt. I'm kind of giggling a little bit because I recently heard the Jim Collins book. Remember The Good to Great? He basically took all of these companies that were good, and then he kind of studied all the companies that were great, and typically it had to do with, hey, how much staying power, like you said, institutional knowledge, relationships. But then I recently read half of those guys are out of business. So I think with the AI world and things changing so quickly, right? We're constantly trying to figure out ways to reinvent ourselves, and maybe Nvidia will still be the king, and maybe Anthropic will still be the king, but I try to stay away from those kinds of predictions. I think you're probably right in general. If you're investing your money, I'm going to personally invest with guys that have been doing it for a while. That's just that's where I feel comfortable putting my money. So certainly, anecdotally, yeah, that's where I'm putting my money. But I think it is interesting as we're rapidly changing so quickly how things you know, get modified.
Yeah, so I've got one more question, kind of more on. We've been on the operator side. We're going to get to the investor side of it, passive investor side here after this question. But as we go on, please submit questions. We want to hear from you all too. We've got questions we can ask for days, but we want to whatever you want to find out, whatever question you have, please put it in the chat and we'll answer it. We'll integrate it into the conversation here. So last one, let's talk today. When you look at a deal today, Chuck, what's something that might kill it in the first 10 minutes of looking at it?
Probably a couple things. One is the seller. There's just some sellers not worth dealing with. You just can't trust them. They don't keep their word. They hide things from you, and those guys develop reputations, and so that's something important to us. Location and demographics. It's like the old thing about you know location. It's true for kissing, and it's true for real estate. I mean, it's all location. And you can't fight location. Now you can see gentrification occurring sometimes, and that's really healthy, good to have. And I guess the other thing would be to make sure that your appetite for debt and equity match the size of the deal. So if John Grady or Connor or Steve or anybody brings a deal, and it's just too much equity or too much debt, we gotta go ahead and just know that that's past our parameters. It's too small or it's too big. You need to go ahead and better say that. Because you fall in love with deals. That's the problem. You fall in love with locations. But if it doesn't fit who you are, you got to say no and move on. So those are the 2 or 3 things I would say is who the seller is, location, and then is the size that fits your appetite.
Yeah, that's really good. I think Andrew, to Chuck's point on the location, is can you find, location is thrown out sometimes by even the let's just say the suits of the real estate world as, hey, I'm going to Dallas or I'm going to Phoenix or I'm going to Atlanta. I'm going to just the big markets, and they kind of resist uh considering the fact that in those markets, there's a lot of troubled areas. There's a lot of troubled
Yeah.
neighborhoods. There's a lot of troubled, work dynamics. And so, when Chuck's hitting on location, there's a lot that goes into it. Chuck, we like, as you know, some of the secondary, tertiary markets. And part of the reason is if they're markets that are balanced and if there's growth and if there's not a new developer coming in every 3 years and pulling out all of our residents, right? And there's still
Right.
bigger guys in there. But I think when people talk about location, they sometimes like to throw out the sexy area, but they haven't considered all the dynamics that go into that.
Amen.
All right, let's move on. Let's move on kind of more on the investor side, specifically passive investor who writes a check or wires the money, hopes for the best. What should they be looking for in an operator, or and what questions should they be asking that maybe they're not?
Well, it's the first time I've said it, so it's people. If you're investing with somebody, get to know them, get some referrals, ask them for their history, and don't be scared if they have a failure. Do not be scared if they have one or two bad deals or some bad deals. It's happened to everybody. Talk to them about how they try to stop it. What did they do? Did they run and just say, tough luck, they lost money, or they worked hard for 3 or 4 years and did the best they could? But I think the person you invest with is the single biggest ingredient of success. Are they persistent? Are they dedicated? Are they going to protect you? Because truthfully, Andy and I and you, Andrew, 95% of all assets, every one of us has access to look at. The debt terms are not very different even. I mean, I know there's some special programs at Fannie Mae and Freddie Mac, but that's really nominal even there. So what he comes to is who is doing the deal and can they execute? And do they have a good team? Find out who their construction team is, find out who their rehab team is, find out who their property management, the debt, the insurance. Make sure they have a good team and that they have a history of success and they have a history of a good reputation. We've lost more money on doing business with bad people than we have on bad deals. You just think somebody's a good guy and turns out they're not. And I now have a rule. You can vouch for somebody, Andrew, and tell me he's the greatest guy, but I'm still going to spend some time with that guy. I need to read it myself. I need to know when I bring my investors that I have done that same due diligence. And I trust you, Andrew, a lot, but that's where I've gotten the most burned is thinking someone knew somebody better than they really did. So.
Oh, so good, Chuck. Yeah, I was thinking about, Andrew, the the same things that are actually getting deals done. And you would think with AI, right? We've got all these opportunities now. I loved Ray Dalio's old book, The Principles, where you just basically he had decision making for every single situation, right? He could calculate who the best decision makers were on his team, and he could just said, all of that. He had like this. We all have that now. We all have OpenClaw. We all have Claude, and it still ultimately comes back to the who's that Chuck is talking about. And it's so interesting that for thousands of years, it ultimately comes back to the who's after all the technologies and things that we try to fix outside of the who's.
Yes, there are some cases where knowledge is special. I mean, there are times where that happens, but that's 1 to 5% of the time. It's the basics 95% of the time.
Oh, so let's get into build to rent a little bit. We're in build to rent. You have some involvement. You've had some involvement in build to rent, Chuck. Would love your thoughts on it. Do you think this is a more of a temporary cycle or something that's can be more long standing? Instead of building, apartments up, that there's going to be more building horizontally, through primarily single family unit communities for rent. What's your take on it?
Yeah, we own a couple. We've looked at building. We've not built anything like y'all have. We have done any development. We've just been buying some. We managed several as well. Certainly there was a hole. There was a certain amount of demographics that had this desire to live horizontally or maybe even non-attached. But I don't know how big the hole is. And, when will that hole be filled up? Secondly, the whole group of people who are like this, oftentimes is that new demographic that doesn't even necessarily want to own something, or, there's so many factors behind the scenes, I think, that I'm not going to say anything that y'all have not thought of, so I'm not, but how long are people going to stay in one location these days because of jobs and just the way the transitory nature of our society? Number two, does this generation who rents cars, rents everything they have in life, they don't own anything, they rent clothes. This is just an extension of that. But then there's also this permanent segment that appears to say, you know what? I don't really need to ever own a house. I like that flexibility. I like the fact that I don't have to do maintenance. I like the fact that I don't have to have a down payment. My parents lost 20% of their money. Not me, but I'm saying some of them are saying my parents lost money with house values on their third house. They made money in the first two houses and they got killed in their third house. So I think there's so many variables. I don't think we've seen the dust settle on this really. But they say when an invasive species comes in to life, like animals, it grows really fast. Like armadillos came into Alabama. They grew like this. But at some point, they level out and come back to a normal, sustaining. And I think that most likely, build for rent, like any asset or any resource, will get overbuilt and then find its own level. I don't know where that level is. My biggest complaint about build for rent, and I think it's a wonderful asset, my biggest concern, instead of a complaint, would be real expenses. I think sometimes people don't really allocate the right amount of operating expenses and capital repairs over time. That's really what has stopped us from investing in several deals, is because I just don't think they were honest for themselves. I've talked to you, Andrew, I know y'all are, but there's a lot of operators that are just kind of pretending. It's more expensive to operate those assets than it is multifamily. That's my experience.
Yeah, this is going to be our first debate, Chuck. Let's just put on the gloves. I want to hear about this one because my contention would be that the residents would stay a little longer. Your turn cost would be a little bit lower because you wouldn't have it as frequent.
Yes.
But I'm so curious about your view on why you think it would be more than multifamily.
Landscaping would be more. Your site work as far as streets and paving, roofing, exterior materials, I don't think it is as big a deal the first 3 to 5 years. I think it's really gonna be a bigger issue at 10 years, 15 years, where the capital items like roofing and asphalt and exteriors and painting, just the pure painting material is more. You have more square footage of exterior elevation in that product than you do in multifamily. Everything outside is more of. But I do agree with you, the turns will be less, and your probably loss of vacancy is probably less as well. But
Yeah.
Andy, I'm not disagreeing with you what you label, but I'm just afraid some people forget there is some other things that are more expensive.
I'm curious. So where do you think, because I think this might be helpful for some folks on the call, where do you think built to rent, and maybe it's, in that 3 to 5 year range, maybe it's even new development, where do you think that they should be underwriting operating expenses? Do you think it's closer to 45% operating expenses or 50? Like a lot of apartments are kind of in that range. So what would be just technically if you're underwriting a deal, what would you guys mark it at?
If my son, who's on the webinar, could talk, he would tell me that answer. I don't know.
Okay, yeah, that's fair.
So
That's
I
fair.
can just say, I like to think I know everything, but I don't.
No, that's what I always tell people when I can't answer. I was like, Andrew knows, Claire knows. Sorry, that's good.
But I
Thanks,
think
Andrew.
Bill for Rent would never go away. it meets the lifestyle needs of so many people today versus the past. The American dream of everybody owning a house and home ownership, went up to low seventies, I think, right? I think that's when it crashed, it was like 72%. We
Yeah.
really too high home. I mean, I love homes. I think it's a great generator of wealth for people, but that's not everybody's dream. And this fills the gap for that dream. Now, also, you pick Foley. That's Baldwin County. It's one of the greatest counties in the eastern United States. I have a house there. I own 3 properties there. I love it. Lafayette. I do a lot of alligator hunting, so I'm down there a lot. So you pick two good markets that are growing, and I would think would be very healthy for what you're doing. So I look
Yeah,
forward to
Andrew, I was reading about, 40% or actually the median age now of new home buyers is 40 years old, right? When we were growing up, it
that's
was late
crazy.
20s, 30.
Right.
Uh, and I think the latest report from Real Data was there's probably 1.2 at least uh, of kind of trapped, families that are in that millennial or just people that are in that millennial and Gen Z range. That's over the undersupply that we're at. Some people track it at 1.5 million. Some people track it at 6. I've seen of units that were undersupplied. Um, I am curious, Chuck, though, if we've got time, Andrew, just what markets you're liking, what you're seeing, maybe how you guys have changed your business, your approach over the last couple of years with AI. If you're like me, you probably turn that over to your team, but it certainly does inform some of your decision making. Where are you guys going over the next couple of years?
Yes. Well, we've always liked the secondary and tertiary markets better. You have to find investors that like that. I mean, we have investors who won't go to Birmingham or won't go to Dothan or Baldwin County as you've done in Foley. But we think generally day in, day out, over long cycles, we'd rather be in secondary and tertiary markets. We think they're more stable. There's less of the herd mentality where somebody comes in from Dallas, and we used to say that never do a deal where somebody from Dallas can get to on a direct flight. That was what we said in the 70s. Of course, Southwest has changed that, but before Southwest is the best advice I would have given you is don't do business where somebody from Dallas can get on a plane and get off in the same hour. They're going to overbuild it no matter what. That's what we always said. Uh, AI answers questions quicker. It gets research quicker. It gets you faster numbers on employment, crime, housing, employment growth, all those things. To me, it's a time saver, but everybody's getting the same information still. In fact, I would argue that everybody's getting the exact same information, more so now than they were 10 years ago because of AI. Because if you're not careful, we're just going to be in an echo chamber, all hearing the same thing. It may be right, it may be wrong, but it speeds things up. It speeds our reporting up to our investors. It speeds up in analyzing our statements on a monthly basis. We use AI to partly look for inconsistencies or oddities or aberrations that don't match, across our portfolio of 200 properties. We will take a set of them, 20 or 30 of them, and put them in there together, trying to look for places to save money or where we're not doing a good job as a management company or as an asset manager. So we're using AI. And when I say we, that's the royal we. I listen to the conversations where people tell me they're doing these things. I've not done any of those things in reality.
Yeah.
My virtual reality is different than their virtual reality.
Are you go ahead, Andrew. I think might have been some questions from the audience too. I don't know. You want to have enough time to get to them.
Yeah, no, go ahead, Andy. I've got one to close on, but go ahead.
Okay. Yeah, I was just curious, Chuck, it sounds like over time your kind of roles evolved. I imagine you're doing a lot more of the kind of, if anybody's read Bob Buford's book Halftime, where you're doing a lot more of the kind of, spiritual, maybe figuring out what's the best ways for me to contribute, build the kingdom, etc. What are your days like typically now? Is it mostly on the relationships? Is it, getting scrums with management updates from your team? Like how are you typically operating your business these days?
You hit the nail on the head. It's changed. I mean, I still will get to some spreadsheets from time to time, but as a general rule, I'm looking to my team to bring me the first draft of everything. And then I'll look over it and approve it and look at it. But I handle more the lenders, the equity, some relationships with some investors. Uh, but I'm certainly not looking at sites. I'm not going and bird dogging things. I do go see them. And then the spiritual side has been a very big thing, Andy, just after our commitment 15 years ago to really be more overt in our faith with our team and our residents. I've been very involved in that. That's probably 25% of my week is strategically thinking about that.
Did you notice when you started doing that, was there any pushback, from friends, investors? There's some people on this call that, hey, look, that's not why I'm here, but I might be contributing some other way. But there's other people on this call that'll be like, hey, I'd like to talk a little bit more about what I do and what I'm trying to do and what I'm trying to build. And if that frustrates a couple of folks, and so be it. How would you respond to those people that are considering whether to do it or not to do it?
Well, two or three things. One is you want a group like Redemptive Real Estate, or there's several good groups out there, but that have annual events and they even have these tables. What do you call these tables? Round tables that they meet with on a monthly basis. So get some exposure. I mean, get some exposure to what people are actually doing. Number two is where are they in the position? Where are they in the company? If they're not as high up in the company, they need to be careful about how aggressive they are. So depending on where they are, what their position is, they need to take that into consideration. And we've offered immersives where we've had 5, 7 people 2 or 3 times come to Birmingham for 2 or 3 days, and we tell them what we're doing. And again, there are other great groups. Launch, Sovereigns Capital Real Estate, y'all, Thompson Thrift, Continental Realty with Dave Snyder, Clayton Edwards at Kenco. There are 7 or 8 groups out there that I respect. And I've gone on road trips to see multiple guys. In fact, we're going to see Thompson Thrift, I think it's next week or the week after, spend a day with them to compare notes of what they're doing with what we're doing. I mean, Andrew and I compared notes when we were in Dallas together. I mean, this is how we learn, is by talking to other people. So if somebody really wants to get on that path, wants to think strategically about how their company could have impact, my first thing would be go to a Redemptive Real Estate Conference, go to a Lions Den event that we host in Birmingham, which is a business's mission Shark Tank. Start to learn the word, start to learn the best practices, and then start slow. Go back to Nehemiah. Don't screw it up by trying to go too fast. You can't expect change overnight with people. But if they see stories, they see and participate, it changes hearts. It changes the hardest heart to see 12 young black men, boys, these are teenage boys, at a property in Bessemer, ran in front of a car the other day and stopped it while the lady's driving in. She's thinking, what's fixing to happen to me? And they make her roll down her window. They say, why do you have Bible studies for adults and not for kids? I mean, that broke my heart. These 12 kids, male 14, 17-year-old kids, said, why do you have Bible studies for my parents and not for us? We had one for them next week. And we found a guy that had been in a gang, tough guy, 6'3", whatever. He said, let me do it. Because I know what they're facing. But these are the kids that came to us. We gotta be listening. I gotta be listening.
That's awesome. Thank you, Andrew.
Yeah, just kind of follow up on that. I think I don't know, just as AI continues to grow, and I think it's something certainly that some of the younger generations, I'm millennial. I'm kind of in the middle of the millennials. But even younger than that, I can remember what it was like without an iPhone, a smartphone, what life was like before we were all connected. But for the folks that are coming after, which some of these are going to be residents in these communities, I see this real craving for authenticity. Part of that is what they've experienced from via social media, or as AI continues to rise, having discernment, what's real and what's not, I think is going to continue to grow.
Yeah.
So, you know, in other words, being authentically you, obviously with discernment and what that is. But I think sometimes we don't give people enough credit that they can kind of sense who we are and if we're being real or not, or if we're a phony. And some people are good at faking it, but I think for the most part that comes through. People appreciate that, even if they don't agree with you, or in a belief system or anything like that. They still appreciate the fact that you're being real, and they can sense that. I think that matters more than sometimes some people give it credit for.
Let me give you an
That's
example of
good,
that.
Andrew.
Let me give you an example of that. So let's see, where's the prayer wall? We've done 11,329 15-minute prayer walks on our 8 properties. So it's 11,329. We ask our people to go do prayer walks because that way they get to pray over the whole property. They get to see Andy walking his dog. They get to see Andrew walking his daughter. And through those chance meetings, they get to engage. We think that the gospel moves by connect, share, gather, train. If we don't connect with you, we can never have a conversation. And so we believe those type of conversations where they say, hey, Andrew, how's your wife? I heard she had a wreck. Can I pray for her? Out of those 11,329 prayer walks, no one has ever said, don't pray for us. And most of those prayer walks, they prayed for somebody. They stopped somebody, talked to them and said, how can I pray for you? Andrew, our brother, people want to be loved and people are lonely. And so it's just about hearing their story and telling your story. All of life is a story, songs, movies, everything we do in life is a story. So why can't we hear their story and tell our story? It just happens to be that God's part of our story. And it comes up naturally. We don't have to do it in a bad, difficult, offensive, demanding way. We just tell our story. And it includes a friend of ours, a good friend. So, I don't even know maybe I just said that because I wanted to say it. I don't even know if it answered anything you said. But anyway, I enjoyed
No, man. And we can't that's the mic drop right there, Chuck. I think that's the part, Andrew. I don't think you could top that with another question or answer.
Yeah. Yeah, no, that's great. That nailed it. I am going to close with this. Just one quick thing. If you could go back and give yourself one piece of advice, you first joined the family business, what would it be?
Um, I'll give a business advice and a spiritual advice. Do these numbers mean anything for you when I say 714 versus 1,330? And 714, you should know what that is. It's Babe Ruth's number of home runs.
Oh,
1,330 is his number of strikeouts. He had more strikeouts than I think almost anybody as a percentage. He also had more home runs than anybody. I would say, I think when I first started, I thought I had to prove myself with my father. And they didn't demand this, my uncle and Mr. Field. No way did they demand this. I think just me demanding it myself. I think I had to go for triples and home runs. I think go for singles and doubles. Somebody told me one time at a meeting, he says, if you hit singles and doubles consistently, it's as if your ballpark gets bigger and bigger. And the singles and doubles the next round are bigger singles and bigger doubles. And so at some point, your singles and doubles are equal to the home runs you tried to do, but you're going to have 1,330 strikeouts too. So I would say singles and doubles are a good thing. Be satisfied with that. And the second thing is the idea of don't despise the day of small beginnings. I told you I'd mentioned it 3 times because I really think we all want to do something big, but most things don't start big. Campus Crusade didn't start big. The United States of America did not start big. These are all things that get built on by people being consistent, persistent, diligent, faithful. And I think stick with it. If you find where you're good, if you become really good at something, you will be successful and have impact. Stick with it. Work hard. Find mentors like y'all. I've had so many people. We're a midget staying on the back of the giants. And that's the old expression. And that's find mentors to invest in you and help you.
awesome. Yeah, excellent. Well, hey, everyone, I just want to thank you for joining us today. It's been a great conversation, Chuck. Thank you so much for coming on, sharing your experience, what you're seeing in the market, how you're focused on really walking out your faith through serving and loving people. A lot of takeaways here. Just an invite. If anybody wants to connect with us more, please reach out. You want to connect with Chuck more, reach out. We'll get you connected. But thanks again, and everyone have a great day.
Thank y'all.
Thanks, Chuck.
Appreciate it.
Thanks, Andrew. Good seeing you guys.